Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of pro tips for reading stock charts and predicting market trends. How to spot trends with candlesticks. Candlestick charts become even more powerful when you stop analyzing single candles and start looking at groupings over time. Recognizing these trends can help you understand the overall mood of the market, whether bullish, bearish, or neutral. Here are practical tips to spot trends using candlesticks. Look for sequences of higher highs and higher lows. This signals an upward trend, showing that buyers are consistently driving the price higher. Watch for lower highs and lower lows. This is a downward trend, meaning sellers are in control. Pay attention to consolidation. When candlesticks have small bodies and wicks overlap significantly, the market is likely in a period of indecision, often preceding a breakout. To make things easier, use support and resistance levels. Candlestick patterns near these critical price points carry more weight. For instance, a hammer at a support line suggests buyers might step in and drive prices higher. Add volume data to confirm trends. If you see a bullish engulfing pattern combined with high trading volume, the trend is likely stronger. Candlesticks are like pieces of a puzzle. A single one won't tell you the full market story, but when you start connecting them, patterns and trends emerge. And once you see those patterns, you'll start making decisions with far more confidence. Identifying trends and trend lines. When it comes to reading stock charts, identifying trends is one of the most important skills you can develop. Trends reveal the general direction a stock's price is moving, and understanding them can help you decide when to buy, sell, or hold. Trend lines serve as visual guides that make it easier to spot these trends on a chart. Paired with tools like moving averages, they offer traders a deeper understanding of market dynamics. Let's break this process down step by step. How to draw trend lines. Trend lines are among the simplest and most effective tools for analyzing stock charts. They connect specific price points to create a visual representation of a stock's overall direction. Here's how you can draw and use trend lines effectively. Start with price lows and highs. To draw an uptrend line, connect 2 or more significant low points on the chart. These lows should form a rising slope, indicating that buyers are pushing prices higher over time. For a downtrend line, connect 2 or more significant high points. These should form a downward slope, showing that sellers are driving prices lower. Extend the line. Once you've identified and connected the points, extend the line across the chart. This forms a guide for future price movements. Remember, the more times the price touches the trend line without breaking it, the more reliable it becomes. Watch for breakouts or breakdowns. When a stock's price crosses above or below a trend line, it could signal a change in direction. These breakouts, above, or breakdowns, below, are key moments to watch for. Trend lines help you visualize support and resistance levels. Think of support as a floor where buying interest keeps the price from falling further, while resistance is more like a ceiling that sellers use to cap gains. Connecting these dots makes it easier to predict potential price movements. Using moving averages to confirm trends. While trend lines are a great starting point, moving averages can add an extra layer of confidence to your analysis. Moving averages smooth out price data over a specific time frame, giving you a clearer idea of the stock's direction. Here are the 2 most commonly used types of moving averages. Simple moving average, SMA. The SMA calculates the average closing price over a set number of days, e.g., 50, 100, or 200. It's great for identifying long-term trends. If the price stays above the SMA, it's often a sign of an uptrend. If it's below, it may signal a downtrend. Exponential moving average, EMA. The EMA gives more weight to recent price data, making it more responsive to current market conditions. Short-term traders like the EMA because it reacts faster to price moves. Here's how you can use moving averages with trend lines. Combine moving averages with trend lines. When a stock's price respects both a trend line and a moving average, it confirms the strength of the trend. For example, if the price stays above an uptrend line and a 50-day SMA, it's likely the uptrend will continue. Look for crossovers. A moving average crossover can act as a signal. For instance, when the 50-day SMA crosses above the 200-day SMA, a golden cross, it's often viewed as bullish. When it crosses below a death cross, it's considered bearish. Think of moving averages as the glue that holds your analysis together. They work hand in hand with trend lines to give you a more complete picture of the current market environment. Understanding uptrends, downtrends, and sideways markets. Market phases are constantly shifting, and recognizing them is crucial to making smart trading decisions. Let's break down the three main types of trends you'll encounter. Uptrends. An uptrend occurs when a stock consistently makes higher highs, peak prices, and higher lows, support levels. The classic definition is, the stock is climbing a staircase. This is typically fueled by strong buying interest. The price moves upward, with temporary pullbacks along the way. In this phase, traders often look for buying opportunities. Use trend lines to track the slope of the uptrend and moving averages to confirm its strength. Downtrends. In a downtrend, the stock experiences lower highs and lower lows. Think of it as sliding down a hill. Sellers are in control, and the price keeps falling, with brief pauses or slight recoveries. Traders often look for opportunities to sell or short the stock. Pay attention to resistance levels, as these tend to cap any temporary recovery within a downtrend. Sideways markets. When prices hover within a narrow range without making significant highs or lows, you're dealing with a sideways market or consolidation phase. This is the calm before the storm, where the market is indecisive. Sideways movement can set the stage for major breakouts, upward, or breakdowns, downward, so it's important to watch closely for signs of a trend forming. Understanding these phases helps you develop strategies tailored to the current market state. Are we climbing a staircase, uptrend, sliding down a hill, downtrend, or stuck waiting for something to happen, sideways? Knowing the answer can help you plan your next move with more precision. When you combine the insight from trend lines, moving averages, and market phases, you've got a toolkit that can give you a clear advantage. Always keep in mind, no single tool or indicator works perfectly on its own. The key to success is combining them to create a well-rounded view of the trend and where it might go next. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.